In this video, we are going to talk about the last aggregate demand management policy, which is monetary policy. Before we have talked about the first type of aggregate demand management policy, the budgetary policy. So the aim of both budgetary policy and monetary policy is to act in a counter-cyclical manner to stabilize the business cycle. And the way they do that is to change the level of aggregate demand. And that's the reason why it is called aggregate demand management policy. In the next video, we are going to talk about aggregate supply management policy. So policies that can design to increase the productive capacity of the economy to achieve long-term sustainable rate of economic growth. For now, let's focus on monetary policy. We are going to talk about cash rate, the charter of RBA, open market operation transmission mechanism, the stance of monetary policy, and unconventional monetary policy, as well as some of the strengths and weaknesses of monetary policy. So let's start with a definition. So I will abbreviate monetary policy as MP. So monetary policy is the manipulation of cash rate. So that's all about monetary policy. And cash rate is a type of interest rate. And it is the shortest interest rate. And it is the interest rate of overnight bank loans. So the duration of this cash rate is only one night. So it is the shortest interest rate possible in the economy. And monetary policy can only manipulate cash rate directly. It can affect other longer-term interest rate indirectly, but the only rate they can directly change is the cash rate. So it's manipulation of cash rate in a counter-cyclical manner. So again, we want to go against the business cycle to smooth out the fluctuations. And it is conducted by the Reserve Bank of Australia to achieve some objectives. And the objective is found on RBA's charter. So specifically, it wants to achieve the goal of low inflation. So which is increase in the consumer price level by 2 to 3% per annum on average over time. So this is the goal of low inflation. And it is one of the main responsibility of the RBA. And if inflation is under control, the RBA is allowed to focus on other objectives such as the goal of full employment and economic well-being of Australians. But the overarching goal is the goal of low inflation. That's what RBA or any central bank should focus on. So why is the main objective of RBA the goal of low inflation? Because the economy can only prosper if inflation is low. If inflation is high, then no matter how well your economy is doing now, it is not going to grow at a sustainable rate and ultimately harms the economic well-being of everyone in the economy. So the goal of low inflation is really you need to achieve low inflation and then achieve full employment and SSEG. It is the prerequisite of all the other two macroeconomic goals. And if inflation is too low, it's also a problem. It causes deferred expenditure because no one wants to spend their money because they know that things are going to get cheaper over time. And because no one is willing to spend money, this reduces consumption, reduces aggregate demand, reduces economic growth, increases unemployment, which is incompatible with the goal of low inflation, the goal of full employment and SSEG. And high inflation will cause inefficient allocation of resources towards things like gold, collectibles, or even cryptocurrencies. So money, instead of being invested, becomes invested in instead of capital machineries, it goes to things like speculative assets, and this can harm the ability for the country to supply products, so harm aggregate supply, and therefore reduces the overall economic capacity of the economy. So how can RBA manipulate cash rate? It is done by something called open market operation, or OMO. And this only applies to cash rate only. For all other types of interest rate, you cannot control via open market operation. It is done by something called a corridor system. So here you have the cash rate, and this is called a ceiling. And this is called a floor. Suppose the cash rate is at 4%. The ceiling is 0.25% or 25 basis points above the cash rate. So the ceiling is 4.25%. The floor is 0.1% or 10 basis points below the target, which in this case will be 3.9%. So anything above this ceiling, the RBA will lend unlimited amount of cash to bank. So RBA is willing to borrow to banks at a rate of 4.25% when the cash rate is 4%. So if banks like Commonwealth Bank wants to borrow from RBA, instead of paying 4% cash rate, it needs to pay 4.25%. And the reason of this will become clear later. And this floor of 3.9% is that RBA's deposit rate. So if some bank have excess cash, it can deposit at Reserve Bank of Australia 10 basis points below the cash rate. So the RBA will pay 3.9% on deposits, and it can accept unlimited amount of deposit. So this basically means that the interest rate on cash will never exceed the two extreme level. So it can only ever go inside this range. Because no one will want to borrow from other lenders at a rate higher than 4.25%, because they know they can borrow unlimited amount of money from the RBA at 4.25%. So if, for example, Westpac offers Commonwealth Bank a 4.3% interest, the Commonwealth Bank will simply borrow from the RBA at 4.25%. So that's why it is called a ceiling, because no one will be incentivized to borrow at a rate greater than 4.25%. So essentially it is a cap on interest rate. Similarly, banks can also deposit their excess cash to other banks. So suppose Westpac offers Commonwealth Bank a rate of 3.8% on deposit. Then the Commonwealth Bank will never deposit their money with Westpac, because they know when they go to RBA can take unlimited amount of money and give them an interest of 3.9%. So the deposit rate, or the lowest interest rate the cash rate can go, will never be lower than 3.9%. So that's why it is called a floor. And nobody says that the rate cannot go under 3.9%, but it doesn't make economic sense for banks to deposit or to lend at a rate higher or lower than what RBA have offered, because they will simply be losing money in that case. So effectively, although it's not legislated, you must deposit or you must lend money with the RBA, but because everyone consider their economic well-being, which is the assumption of rationality, this effectively becomes the ceiling and floor of cash rate. And suppose now the RBA changes interest rate. It reduced the cash rate. So now cash rate is 3.75%. It reduces the cash rate by 25 basis points, or by 0.25%. And now the cash rate is at 3.75%. So this is the new cash rate. So the ceiling when you go up 0.25% is 4%. The floor go down 0.1% is 3.65%. And the corridor, so this thing is called the corridor, will shift down automatically. So everything shifted parallel downwards by 25 basis points. And that's how the interest rate changes. So after the policy announcement, the corridor will immediately shift down. And then the cash rate, instead of moving between the two range, it will be moving between the new range. There is no need for human intervention. Everything occurs automatically. And because of this incentive, or the care of self-interest, we know that the cash rate will always be between those two bonds. But maybe the Reserve Bank wants to make the cash rate precisely 3.75%. So it doesn't like this fluctuation. And then it uses open market operation. So suppose the interest rate is at 3.9% now, which is above the target. And the Reserve Bank wants to make the cash rate, actual cash rate, as close to the announced cash rate as possible. And they can do this via open market operation, which is the buying or selling of government bond. So when the actual cash rate is above the target, the RBA wants to decrease the interest rate. And they do that by buying government bond from banks. So let's walk through the logic here. So you buy a government bond from the bank. Government bond is a piece of paper. It is the promise that government will repay your interest, repay your principal. But it is essentially just a piece of paper. So for buying, you need to pay money. You need to pay cash. So when you buy a government bond from the bank give this piece of paper to the RBA. And RBA gives bank cash. And this cash needs to go somewhere. So the banks need to deposit this cash to other banks. But now, since you have more supply of cash, Then based on the demand and supply diagram, we know that the price of this cash, which is just the interest rate, because interest rate is essentially the price of money, decreases. So we can decrease the rate towards the 3.75% target. And the RBA may continue on this process until the actual cash rate is 3.75%. So when the actual cash rate is lower than the target, maybe 3.7%, it do the reverse thing. So buying the bond decreases interest rate, and sell bond to banks increases interest rate. So why is this the case? So bank gives RBA money because when RBA sells bond to bank, the other way to say it is the bank buy a bond from RBA. So it needs to pay RBA cash. And RBA gives this bank a piece of paper. So bank gives RBA cash. This means you have less supply of cash. And from demand and supply, you know the price of cash or the interest rate would increase when when the supply have decreased. And so it will move upwards towards the target. So that's all about open market operation. I know that the textbook makes this topic confusing, but in fact it is a relatively straightforward topic when you see this from a demand and supplies perspective. So now let's move on to the next topic, transmission mechanism. Many textbooks explain this topic incorrectly. So it actually has two different stages. So stage 1 talks about how changes in cash rate affect other interest rate. So interest rate looks like this, usually. Sometimes it can have different shape. So usually as the year, so a 30-year bond which matures in 30 years would have a higher interest rate than bond that matures in 1 year, because you need to compensate investors for lending your money for so long, for 30 years. And so you need to pay a premium called liquidity premium to compensate for this loss of flexibility for borrowing money to you for 30 years. If I borrow money to you for 1 year, I can get my money back in 1 year. But for a 30-year bond, I can get my money back after 30 years, which is a long time. And you know the shortest duration of interest rate is the cash rate. And cash rate is the anchor point of other interest rate. So when cash rate increases, it drags up other interest rate. When it decreases, it drags down other interest rates. So that's why we call them the anchor point. Because suppose the yield, so this is called the yield curve, looks like this. So this is the cash rate. And this is the longer year bond. Then who would buy 5-year bond, which pays a lower interest than the cash rate? So people will go towards this lower duration market, like the cash market, and buy cash. And we know that when we buy cash, the yield of cash decreases because the price is inversely related to the yield. So when the interest rate increases, the price of bond decreases. When the interest rate increases, the price of bond decreases. So when demand becomes high, the price increases. If the price increases, the yield will decrease. So this would have a downward pressure on the yield. And everyone sells the 5-year or longer bond. When someone sells, the price decreases. When the price decreases, the yield increases. So gradually it will return to this shape. And the cash rate is still the anchor point of the yield curve. So it have this ongoing effect on longer term rate as well. So it is a benchmark interest rate in the economy. So this is the stage 1 of the transmission mechanism. And this part is often overlooked in textbooks. So now let's look at stage 2. So stage 2 is how changes in interest rates. So stage 1 goes from cash rate to interest rate. Stage 2 goes from interest rate, which is not cash rate, to the economy. So be very clear of the distinction between the two. So this is done via something called the transmission channel. There are 5 transmission channels in total, and you need to know all 5 of them. They will likely to assess you in the exam. The first channel is called the cost of credit, or the savings and investment channel. So this is about new deposits, new loans. The key word is new, because for existing credit and savings, it is a different channel. So if the interest rate decreases, then the cost of borrowing decreases. The reward or the interest of savings decreases because the interest rate is lower. It's cheaper to borrow, but you don't get a high return on your savings account. So the combination of these two factors, when you have lower cost of borrowing, you increase investment, increase consumptions, because people are discouraged of save money, and they may use credit cards because now the interest rate is lower. So increase consumption, increase investment, you know it shifts AD to the right. And this increases GDP because it increases production, decreases unemployment rate, also increases demand inflation. So that's the first channel. And of course, if interest rate increases, it's the opposite effect. The second channel is the cash flow channel. So this is about existing loans, especially variable interest rate loans. So if interest rate increased, then household businesses with existing variable rate loan. So fixed rate loan is not affected by interest rate. Only variable interest rate loan, which changes with interest rate, would be affected by the cash flow channel. They need more money to service the loan, and hence decrease the discretionary. So note, this is not disposable income, it's discretionary income, because discretionary income is income after tax and after paying mortgage, and decrease cash flow. So they have less purchasing power, thus less consumption, less aggregate demand. So less aggregate demand decreases CPI. Decreases inflation, decreases GDP growth, increases unemployment. And this is what the government around the world is trying to do. It tries to decrease the rate of economic growth and thus depress the rate of inflation. So that's the reason why government are raising or keeping a very high interest in the economy, because it would make people decrease people's discretionary income, and therefore it helps to reduce demand inflation pressures, which can thus decrease the rate of inflation. The next channel is the exchange rate channel. So when interest rate decreases, then the relative interest rate to other countries. So this assumes that other countries does not decrease the interest rate or decrease. And because the return on, let's say, Australian dollar due to this decrease in interest rate becomes lower, but the US Federal Reserve does not cut their interest rate. So now that you can earn a higher return with US dollar assets. And so investors will chase countries with higher interest rate or a higher return by selling AUD. And selling means higher supply. And the effect of this action is that we have a depreciation of Australian dollar. And as we have discussed in the video about exchange rate, depreciation increases the level of international competitiveness. And when the international competitiveness increased, this boosts export and decreases import. So why is this? When Australian dollar depreciates, then Australia-made goods and services becomes more attractive or cheaper from the perspective of foreign purchasers, because Australian dollar is worth less. So for any given amount of Australian dollar that Australian sellers want, overseas buyers actually need to pay less in their own currency. Similarly, because Australian dollar is worth less, then imported goods and services becomes relatively more expensive. And because of this reason, people may prefer locally made goods and services. And thus it decreases import. And we know that export is injection to the economy, import is leakages. So overall it increases AD. When aggregate demand increases, you know the story. So the inventory of firm decreases. So firm increases production. Increases production, increase GDP. Increase in production means we have more demand for labor. More demand for labor means lower unemployment rate. And as well as high GDP is linked with higher rate of inflation. So that's how the exchange rate channel works. The main thing is to link the exchange rate channel to aggregate demand. And once you can establish this link via what I have provided you, the rest of the story is exactly the same as all the other channels. So the difficult thing is to connect the channel with aggregate demand. As soon as you can do that, the rest of the answer should be exactly the same, because the impact of different level of aggregate demand on the economy will be exactly the same. So I will use this strategy for the next two channels. So the next one is the availability of credit. So this is your borrowing power. So increase in interest rate means more repayment, as we have already discussed. And because you need more repayment, you have less ability to borrow money for the same income. So suppose you have the ability of paying $500 every week to service your debt. And if interest rate increases, now you need $600 to service the debt. And so because of that, because you're only able to repay 500, the bank will borrow you less money than before. So your repayment is still 500 after this increase in interest rate. But because the interest rate increased, you can borrow less money than before. So when the interest rate is 5%, you pay $50,000 in interest every year. But now when it's 7%, you need to pay $70,000. So when interest rate is 7%, and you are only able to repay, let's say, $50,000 of income, then you can only borrow $714,000. So because at a 7% interest, this corresponds to $50,000 per year of interest. But if the interest rate is 5%, you need to borrow $1 million to pay $50,000 in interest. So the ability for you to borrow decreases if the interest rate increases. And that's why the property price usually drops when interest rate is higher, because you are less able to borrow money under a high interest rate environment. The last channel is asset price, so which links nicely to what I have talked about house price before. Oh, also maybe I need to establish the link. So you have less ability to borrow, thus you have less purchasing power. So reduces consumption, reduces investment, reduces AD. And once you have linked the availability of credit to aggregate demand, then everything is the same. So you just copy this part. You have less, you have more inventory, you have less production, you have less GDP. Less GDP means less demand for labor, higher unemployment, thus lower inflation. So it all becomes very straightforward. Asset price. A decrease in interest rate means people can borrow more money at cheaper rate. So this increases demand for assets like property. And because the demand increases, this will push up price of assets. And so asset owners feel rich. When they feel rich, they increase consumption. Because now you are richer, then you cannot drive a Toyota anymore. You need to buy Mercedes. And so consumption increases. Consumption increases aggregate demand. And increasing aggregate demand follows exactly the same structure as the previous answer. Inventory, and then demand, GDP, unemployment, CPI. Everything else is the same. So if you can link asset price with AD, then you can confidently answer the question easily. Now let's look at the stance of monetary policy. High interest rate, low interest rate. High interest rate is contractionary. Low interest rate is expansionary. Why is this the case? Go back to the transmission mechanism and look through each channel in detail and think how does higher or lower rate affects the cash flow channel, the exchange rate channel, the availability of credit, the asset price channel, and you will know why it is contractionary or expansion. Just a tip, Contractionary decreases GDP. Expansionary increases GDP. Lower GDP means lower inflation. Higher GDP means higher inflation. So usually when the economy is running very hot, the inflation is high, then we use contractionary monetary policy to decrease inflation. If the economy is in a recession with deflation or a very low rate of inflation, then we use expansionary monetary policy to stimulate the economy and increase the consumer price index. A new addition to the study design is the unconventional monetary policy. So some examples: quantitative easing. So quantitative easing is the manipulation of other longer duration interest rate. So how does this work? So you can either buy or sell bonds. Buy a bond increases price, and because of this inverse relationship decreases the yield or the interest on this bond. Selling the bond decreases price and thus increases the interest rate on the bond. So if the central bank wants to change longer duration interest rate directly, for example, the 3-year government bond. So why does central bank wants to do it? 3-year bond in Australia is tied to mortgage rate. And mortgage is the most important source of borrowing from households. So if they can directly change the interest rate on 3-year bond, they can directly influence the mortgage interest rate. I know that when we talk about the cash rate, I said it is an anchor to other longer term bond, but it is not very direct. It only affects it gradually. But when you directly go into the market for 3-year bond and buy and sell those kind of bond, then you can directly change the interest rate on that bond. And when you do that, you can directly change the mortgage rate. So it makes monetary policy more powerful. So during COVID, the government actually, or the central bank actually purchased a lot of 3-year bond and to drive up the price, thus decrease the yield or decrease the interest rate to 0.25%. Nowadays, it's like 4%. Because the price have fallen, so the interest rate have increased since the RBA have since stopped buying 3-year bond. So if central bank buy the bond, it artificially increase demand and thus artificially increase price and artificially depress the interest rate. So that's the essence of quantitative easing. And by the way, some people call this printing money, which makes sense because the money used to buy this bond is not the money actually owned by RBA. The money is created from nowhere. So it is the RBA used the money they have created to buy bond. You can also have forward guidance. So this is the governor, the Reserve Bank governor guiding the market, such as we won't increase interest rate until 2024 at the earliest. So this is forward guidance. So it is a kind of like a promise, but not a binding promise from the central bank governor that with respect to their interest rate decision. And this is actually what Philip Lowe, the previous Reserve Bank governor, have said during, I think, 2021. But of course, the interest rate increased significantly since 2021. So it is not a promise, it is a guidance. And sometimes this guidance is not trustworthy. So it is only effective if people trust in the forward guidance. So you can only play this game really a few times. If you constantly walk away from your guidance, then eventually the forward guidance will become ineffective because nobody will trust what you say. And if nobody trusts what you say, then what you say is not important anymore. The last topic, strengths, weaknesses of monetary policy. We are doing a comparison here. It is relative to budgetary policy, which we talked about in the last video. Strengths. We have a short implementation lag because changes to cash rate is immediate. From this, we have also talked about this before. From this interest rate corridor, it occurs instantly. Also, it can influence expectations. So budgetary policy, you need to actually do stuff. You need to increase tax, you need to increase spending, you need to do this, do that. But for monetary policy, you can use forward guidance. And you just talk. You talk that we're not going to decrease interest rate. You talk we're not going to increase interest rate. You don't need to do anything. By just talking, with one condition though, that people believe or trust in the central bank, which is usually the case in developed economies. You just say a few sentences and you can have a powerful impact on the economy without you actually do anything. So this is also one of the strengths. It is quite handy because you don't need to do any work. But of course, you need to be credible. If you're not credible, then this second factor becomes a weakness rather than a strength. So there are some weaknesses as well. So Australia have high household debt, making the cash flow channel ineffective. So remember, the cash flow channel is associated with lower mortgage repayment, so households are able to spend more money and increase consumption, increase AD. But because Australian households have a lot of debt, with this extra cash flow, they may choose to repay debt rather than to spend this extra money. And when they choose to repay this debt, there's actually zero effect of monetary policy on consumption. Because the goal is to make people spend money. But if people are not spending money, then the channel becomes ineffective. So that's why during COVID, we need to decrease interest rate by so much to stimulate the economy, because we have such a high level of household debt. The second weakness is it can only control cash rate directly. But this weakness can be addressed by using unconventional monetary policy. So it is really not a big problem nowadays with quantitative easing. So this is a key disadvantage of monetary policy. It's long impact lag. So it usually takes 18 to 24 months for rate cut or rate rise to be felt in the economy. Because it takes a long time for the cash flow channel to kick in because of so many problems we have discussed, like high level of debt. People choose to pay down their debt. People may save the money instead. So it takes a long time for a cut or increase in interest rates to be felt in the economy, especially for cut. Because when you raise the interest rate, you need to pay more repayment. So you immediately get less money to spend. So it is powerful in slow down the economy, but it is not powerful to speed up the economy because people can have a choice of what they do with this extra amount of money. They may not choose to spend, they may choose to save the money. And in this case, monetary policy becomes very ineffective. The last weakness is blunt instrument. So changes in interest rate affects the whole economy, affects everyone in the economy. So for example, Western Australia is doing very well, but Victoria is doing really bad. And monetary policy cannot help in this case, because it either benefits everyone or it harms everyone. But for budgetary policy, we can actually target, for example, the Victorian economy. So it is more flexible. Interest rate affects everybody, so it is blunt instrument. And we know that the impact lag for budgetary policy is very short, because when you spend money on infrastructure, you are immediately pumping money into the economy, and then immediately increase AD. But for monetary policy, you need to go through all these transmission channels. And budgetary policy is not affected by high level of household debt, because government can spend money directly via things like infrastructure. Perhaps the most important strength of monetary policy is that it is free from political bias, because RBA is independent from the government. So RBA does not need to buy votes, unlike government need to. So they can act really in the best interest of Australian people. And this is a key advantage of monetary policy. They can introduce very unpopular policies, such as increase interest rate, but it is actually in the best interest of Australian people in the long term. So in the exam, when they ask you about the strength of monetary policy, be sure to include this point, because that's really the key advantage of monetary policy. So that's all for today's video. In the next video, we are going to move on to the last area of study, which is aggregate supply policies.